Stop confusing high inflation with a weak dollar. I see so many investors mix these two up, but they are completely different market conditions that can hammer your portfolio in opposite ways. One might be killing your tech stocks while the other is secretly boosting them. Let's do a deep dive and clear this up for good, focusing on two key assets, tech stocks and real estate. First, let's talk about tech stocks. Think of companies like Nvidia or Meta. They're what we call long-duration assets. Why? Because their value today is heavily based on the massive profits they expected to make far into the future. Now, let's run the scenarios. Scenario A. High inflation. This is the 2022 playbook all over again. When inflation spikes, what does the Federal Reserve do? They hike interest rates. This is poison for tech stocks. Suddenly, the discount rate used to calculate the present value of future earnings goes way up. That dollar Nvidia is projected to earn in 2030 is worth a lot less today when interest rates are 5% compared to when they were near zero. The result? Valuations get crushed. Stock prices can crash even if the company is doing great. So, high inflation is generally bearish for tech. Okay, now scenario B, a weak dollar. This is a totally different ballgame. Here, the dollar is losing value against other currencies like the euro or the yen, but interest rates might be stable or even falling. This is actually a huge boost for big tech. Why? Because these companies are global powerhouses. About 60% of Apple's and Alphabet's revenue comes from outside the United States. Think about it. If Apple sells an iPhone in Europe for €1,000 and the exchange rate is 110, they bring in $1,100. But if the dollar weakens and the exchange rate moves to 120, that same exact sale now brings in $1,200. They just made an extra $100 without selling a single extra phone. Their earnings reports look amazing. So, a weak dollar is bullish for megacap tech. Next up, real estate. It's a hard, tangible asset, but it's incredibly sensitive to the cost of borrowing money, mortgages. Let's look at scenario A again, high inflation. The cost to build a new house skyrockets, lumber, labor, everything. At the same time, the Fed is jacking up interest rates to fight that inflation. What happens? We get a stagflationary freeze. The cost to replace a home is high, which keeps a floor under prices. But mortgage rates jump to 7 or 8%, absolutely crushing affordability for buyers. Nobody can afford to buy, and sellers don't want to sell at a discount. The market just freezes. Transaction volume dries up. The verdict here is neutral to stagnant. Your property value might hold, but good luck trying to sell it. Now for scenario B, a weak dollar. This is when U.S. real estate effectively goes on sale for the rest of the world. For an investor holding euros or Swiss francs, that Miami condo or New York penthouse suddenly looks 20% cheaper. This triggers a wave of foreign capital. International buyers rush in to scoop up trophy assets, parking their cash in a stable country and driving up prices, especially in those prime luxury and coastal markets. So, a weak dollar is very bullish for certain types of real estate. So what does this all mean for your portfolio? Let's recap the winners and losers. We've seen that high inflation, with its high interest rates, is generally bad for stocks. But a weak dollar can be fantastic for multinational companies. So who are the biggest winners when the dollar is weak? The first group is commodities. Things like gold, oil, and even Bitcoin are priced globally in US dollars. If the value of the dollar drops, the price has to go up immediately just to maintain the same value against other currencies. This is why you see companies like Exxon or the gold miner Newmont do so well. The other clear winners are those global tech giants we talked about: Apple, Google, Amazon. They're raking in foreign currencies, and when they convert those euros and yen back into weaker dollars, their earnings get a massive, artificial boost. Understanding this difference is not just academic, it's the key to protecting and growing your portfolio. Stop thinking about inflation and a weak dollar as the same thing. They are not. One is a headwind, the other can be a powerful tailwind. Thanks for watching. If you found this helpful, make sure to like this video and subscribe for more deep dives to make you a smarter investor. See you in the next one.